Welcome to the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Hey everybody, and welcome back to the Teaching Tax Flow podcast, episode 98 today. We are going to dive headfirst into those top three or the top three tax landmines. So you probably have no idea what those are, and that's okay. That's a good thing. That's what we're here for. We are going to discuss those with you in just a moment, but as always, let's take a very brief moment and thank our episode sponsor.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, REPS, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
Hey everyone, here we are back again on the podcast. We are going to talk about this topic today. We are going to have a little fun here, and we're also going to try to uncover what in the world Chris calls these tax landmines. In all transparency, he gave me this topic. I kind of have an idea what it is, but I really have no clue what they are. So I guess the best way to solve that, right? Come to a solution, get the best answer, is to ask the man himself. Chris Picciurro, welcome back to the show, sir. How are we doing?
Oh, I am wonderful. It's great to be back, Johnny T. And had a great weekend. We had high school football starting here in the state of Tennessee. We had college football really getting into full force next weekend. Kids are active. We're in the swing of getting into school and ready to tackle, a little pun, tackle some of these items that, quite frankly, in over 20 years of experience being a CPA, we've had several people run into what we call these landmines. And ultimately, even for an experienced tax planner, you might be making maybe a great financial decision for yourself, but you might be running into uncharted waters and consequences that you didn't plan on from a tax perspective.
And it's funny, you mentioned, it's back in school, right? It's almost like these darn tax deadlines. They just keep coming back around every year. You know they're coming. You try to avoid them. Well, although some people love it when their kids go back to school because they're out of the house. The house tends to stay a little cleaner.
Yeah, the best way I could describe it would be is, let's say you're on an expressway and there's a huge accident, and you look at your GPS and you realize, oh geez, if I stay here, I'm going to be stuck for an hour or so. So let's say you get off the interstate onto a country road. However, you run over a nail and pop your tire, right? So you're fixing one problem, but you might have inadvertently ran into another problem. So we want to make sure that people understand, and that's what's so important. One of the three laws of teaching tax flow is that tax flow does not equal cash flow. And that means that just because you might receive or not receive cash doesn't mean an event's not taxable. So I'm excited to run into some of the, I can't say I'm excited to do this topic because it's usually a difficult conversation for people that don't do tax planning and are very reactive. However, I think by people listening to this podcast, this episode, you're going to get an understanding of what things you can avoid in advance.
And Chris, if I can add to it too, right? I mean, we always, and I say that in a non-marketing pitch, we literally always talk about tax planning, right? So let me kind of add this before we do jump into them, right? So tax planning really is just that. And I think the most important part of what I've always taken from it, at least in our discussions and talking to other tax pros, and a lot more people are starting to actually do it because they realize it literally tells you, in a sense, it tells you what to expect. It's not, oh crap, you sit there and you're very anxious, whether it's somebody that just has, a W-2, so say they're a full-time employee or they own their own business. It's almost like getting a leg up on quote unquote tax day and I'm doing air quotes for those that can't see that, because I know Chris loves it when I refer to tax day or, tax season. But it literally tells you what you can expect. So it kind of takes the worries out of it. And then Chris, also, I'd say, again, kind of through osmosis, me not being a tax pro, I think the most powerful piece that comes from those conversations with you and others in your industry is that there's a lot of stuff you can do even after the end of the year. It's not like, December 31st, you're like, oh crap, I got to run out and I got to get a vehicle. I got to get an office. I got to expense all the stuff and try to offset and do all this and blah, 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 blah. It turns into a disaster and, it's not a good situation. And I think one of the funniest things, right, is like the IRS gives you really the playbook. It's up to you to look at the damn thing. Pardon the French there.
Ooh, a 4-letter word. Well, good segue when you said buy a vehicle. So my number one issue with the tax landmine, right? A tax landmine is the concept of depreciation recapture. And what this means is that if you take a depreciation deduction on any type of asset and subsequently sell the asset, you have to recapture that deduction and put it back into your income. And I see there's two cases where this really plays a role. The number one by far is whenever you have a vehicle. So let me paint a picture for you, John. You've got Johnny. Remember you were knitting Afghans a couple episodes ago.
That's right. I wonder if they're going to make that an Olympic sport. Then we go.
That would be nuts. I mean,
my grandma would be so proud if I actually knew how to do that, but I have no clue.
Well, you know what? You've got other skills. So and I know that you're you love construction. So let's assume you've got Johnny T, contractor, not too far-fetched. You go on December 27th and you go buy a $90,000 F-350. But I don't even think you can get one for $90,000. But let's just assume you can. And you say, you know what? I'm going to take Section 179 depreciation and bonus depreciation. I'm going to write off the entire $90,000 year one, which is completely legit, assuming you have 100% business use of the vehicle. So you get that deduction. And let's say you did that in 2022, okay? You wrote off $90,000 of that truck. Well, let's say you put 10% down and you're carrying an $81,000 loan, right? A couple of years pass. You say, you know what? I don't want to use this truck anymore. I've got a crew now. I'm subbing everything out. I'm just going to get a kind of smaller vehicle and I'm going to run and do estimates. And that truck's a burden to you. So you go to the dealership. They say, look, man, I'll give you a trade-in of $60,000 for that truck. You look and you owe $60,000, right? You're thinking to yourself, do you have any cash in your hand? No, you don't, because you traded the vehicle in for a $60,000 credit, but you owe your payoff $60,000. However, you owe $60,000 worth of tax, or you owe tax on $60,000 worth of income. Why? Because you wrote the entire vehicle off, meaning your basis in that vehicle from a tax perspective is zero. So even though you don't take any cash in your pocket, you would have a $60,000 taxable event. Now, if you buy a new vehicle, you might be able to take a deduction for that new vehicle, but if that vehicle is not 6,000 pounds and bonus depreciation percentages are different, there's no guarantee you can get a $60,000 deduction to offset that income. So that happens a lot with taxpayers saying, oh, I traded the vehicle in and I didn't get any cash. It doesn't matter. You ultimately took an immediate deduction.
And I could see how easy that could happen.
It happens all the time. So depreciation recapture is one of those boo-boos where if you don't do tax planning and you work with you have the best tax professional in the world, they can't fix that at the end of the year. So you might have someone that, or maybe they had 3 or 4 vehicles, or maybe they use that vehicle as 100% business use, and after a few years, they buy another vehicle and they let their spouse use that vehicle, and now there's not a lot of business use. There's still depreciation recapture.
I can even see how that could happen. I mean, obviously, there's pros and cons with a lot of situations, but say, for example, like you said, you buy a vehicle, it qualifies, under what we call the 6,000 pound rule. So if anybody's curious on that, look that up. A lot of information on it. Some of it's a little deceiving. Not saying our stuff, but just in general, look up the 6,000 pound rule. I could see that happening where, say, somebody goes out and they buy say $100,000 vehicle. They have it for a year. And then they say, oh, you know what? I'm going to get rid of this one. Say I owe 90 on it, but I found a used one that's just like it for, 30,000. They think, great, it's awesome. I already wrote this off, but now I get a better deal on here. So sure, you get a wash, you're probably not paying as much for that, but yeah, the little tax devil rears its ugly little head again without you knowing it.
Ultimately, it's the taxpayer's responsibility, because from the taxpayer's perspective, they're probably thinking, well, I paid 90, I'm selling it for, trading it in for 60, so I have a loss, right? But they don't remember that they took all that deduction immediately. I'll give you one more example of depreciation recapture. Let's take it to real estate. Let's assume you had bought $1 million short-term rental property in 2022, all right? You put 10% down as a second, you financed it as a second residence. So you have a $900,000 loan. And let's say you didn't make a lot of interest payments, and you did what's called a cost segregation study. So you were able to deduct $300,000 of the $1 million. So my point is you have $700,000 of that home, right, that you have not deducted yet, but you owe $900,000. Let's say that time, the market goes down, that mortgage is a burden, and you say, look, I'm dumping it for $900,000. I just want to break even. Okay. You sell for $900,000. Obviously, there are closing costs, but you sell for $900,000. You pay off your $900,000 of loan. You have $0 in your bank account, right, at closing. You also, in your mind, are thinking, I paid $1 million and I sold it for $900,000, and I should have a loss on my tax return. You have a $200,000 taxable gain. Why? Because you took $300,000 deduction year one with a cost segregation study. My point is, when you're selling assets, especially assets that use Section 179, a cost segregation study, or bonus depreciation, work with your tax professional before you complete that transaction, because you will have depreciation recapture.
I'm here. My wheels are turning. I could think of all kinds of examples of that.
And those are the most common, right? There are a lot of them. So that's depreciation recapture, which is now a cousin of depreciation recapture is going to be my number two strategy. Not strategy. It's the opposite of a strategy. It's a pitfall or landmine. Speaking of, remember the Pitfall, that video game on Atari? I never had an Atari, but you had to jump on those alligator heads.
I couldn't make this up if I tried. I haven't heard the word Atari in probably 10 years, and somebody just mentioned it to me this weekend. I'm like, oh, that's interesting. I remember that thing. I remember it used to be in my parents'. I mean, anybody that had like an Italian family always had a lot of glass doors. It's on cabinets. I remember this Atari sitting behind this little glass door. I had to open it up, wipe my fingerprints off it, because of course as a child I put my entire handprint on this thing to open it, not on the little thing. But anyways, we'll do a whole nother episode on that.
Oh, that's right. I got one more quick one on as far as Italian families. I remember my dad's mother, or my grandmother, whenever she lived in Roseville, Michigan, for those of you from the Detroit area, whenever we would go to her house, she had some type of plastic, like you're going to a model home, going from her, covering her family, or the formal, living room that no one went in or lived in. She also had covers on her couch. So you had to walk on that plastic to get to the kitchen, just in case, right? Anyway.
It's almost like that's how they used to know when you're creeping around, right? Because they hear you walking. It's like walking on bubble wrap. It's funny, you mentioned that too. I mean, the covers that I remember my grandmother had on her couch, I didn't even know what the couch actually looked like until we had to get rid of it. I'm like, oh, that's actually a nice couch. Nobody sat on it for 40 years, literally.
Well, I will say the number two tax landmine, we went down a rabbit hole with Pitfall and Atari and our grandparents, would be the concept of phantom income. So depreciation recapture can be phantom income, but it's not always. But phantom income, what that means is that you have income on paper, but you really didn't get any cash. You might be saying, what are some of the most common examples of phantom income? The first one would be cancellation of debt income, COD. All right. Now, there are some exceptions where cancellation of debt could potentially be tax-free if it's student loan debt or if you're insolvent. But let's say Johnny T out there, running around, racks up, $60 grand worth of credit card debt. He was, but back in the good old days, he was living large, and he kind of gets himself together, pays down some of that credit card debt. However, $40,000 of it is forgiven. He gets a 1099 showing cancellation of debt income of that $40,000. John, you don't have any cash, but that's a $40,000 taxable event. So that can happen. That can happen with medical bills. It could happen with so many different fact patterns that cancellation of debt is an example of what we call phantom income. No cash in your hands, taxable event.
Is that almost, and not to go down another rabbit hole, because I know there's probably some complications to this, but is that almost the situation with, I know there was a big string of time where student loans were being forgiven, I believe, or some of them went through. I don't know all the details, and then I'm sure there was something that followed that where they were trying to get that to opt out of that and all kinds of stuff, right?
Right. Student loans, you ultimately would rather pay the tax and then it'd be a lot cheaper to just pay the tax on the amount forgiven than actually pay it back. There are some special student loan programs and there are some student loan debt that's forgiven is tax-free. But typically you're going to see it most often on consumer debt.
And then there's a lot of I'm sure everybody has either seen one of these commercials, a Facebook, it's something out there, right? It's like, oh, call us. We settle for, I don't know what the number is, settle for a 10 cents on the dollar and all that. So that would be a great example of that. And I'm sure that qualifies too for personal and business debt. Correct? Would that be the same?
Mm-hmm. Absolutely. It could be. There could be a lot of different types of cancellation of debt income that comes into play. And if it's taxable, that's when it's that phantom income. Another example that we see often is, and there's some other podcast episodes on this, is partnership income. Well, you're an S corporation income. Let me give you an example, but let's think about partnership income. Remember, you're as a partner in a partnership or partner in an LLC taxed as a partnership, you're taxed on the profit and loss of the business, regardless if you take the money out of the business or leave it in. So let's say, Johnny T, that you and I start a business and we're a retail t-shirt company, right? And we made $200,000 last year. However, at the end of the year, we really needed inventory because it was the holidays, or let's say that, for some reason, January is a big month for us. And we take out of the $200,000 of the profit, we take $150,000 of it and buy more inventory. And then you and I leave $50,000 in the business for operations. Our K1s, oh, by the way, there's another episode called K1s for Dummies. Not that you're a dummy, but our K1 would say, John, you owe tax on $100,000. Chris, you owe tax on $100,000. Do we have cash? No, we don't. Is the inventory deductible by the company? No, it's not, because not until it's sold. So sometimes you'll have that K1 income that you are allocated that income. Typically it happens in a partnership, but you didn't receive any cash. Either the cash is retained by the business or it's invested in assets that are not immediately deductible. So it's another phantom income or paper income. The final one.
I love that you call these phantom income because it basically just kind of, it is what it is, right? It just kind of slides.
Yeah, it's on paper.
Without you knowing it, unexpected.
Well, exactly. It's on paper, but it's not really money in your pocket. It's kind
of like when I do the laundry in my house, I phantomly do the laundry. It just maybe shows up, but it wasn't me that did it.
Or you probably do it wrong.
I can only teach my 3-year-old to
doesn't make you do it. That's always a good strategy we've talked about. Final one would be barter income, right? So let's say you own a business. You're Johnny T Construction. You do a job for someone. You bill them $5,000. In lieu of the $5,000, they're like, well, listen, I know your daughter loves Beanie Baby, so I'm going to give you that Princess Di beanie instead of paying. You didn't get any cash, but ultimately you were compensated with an asset. So that technically Princess Di Beanie Baby, if its value is at $5,000, is income to your business, but you don't have any cash. You have a Beanie Baby. Congratulations. That's the final example of phantom income. There are several examples, but I think if you're listening to this, you're getting the point of there's certain situations where you could have phantom income and the trouble is if you don't have the cash to even pay the tax on the phantom income, then you really have trouble.
Then back to where we started too, a little bit about tax planning, right? we talked about the vehicle a little bit earlier on. We talked about some of the phantom incomes. The more planning you do, you have a longer foresight, we should say, right? So you can kind of see what you can do. You kind of know what's coming up, and it's obviously, Chris, knowing you for well over half my life, well over half my life.
So young, John.
Having somebody young blood, having somebody that really knows your situation and kind of knows your habits, activities, your business is so important, right? Like, Chris, if I came to you and said, you know what, I'm going to start a construction company, and I didn't know anything that we talk about, you would be like, hey, have you considered just getting a truck that's over 6,000? Like, little stuff like that rolls in. And then, of course, before I went and sold it, I would have said, hey, I'm thinking about this. And you would have grabbed your pickleball paddle and whacked me right upside the head and say, hold on to the darn, you know what I mean? So building that, we did an episode again way earlier on about building your board of directors. Go listen to that. Very important. That's kind of what I'm getting at here. Well, yeah, let's talk about a little bit more of these landmines, right? So
the third one, the third one, and then I'll have a bonus one.
I like the
for
sound
you,
of that.
Believe it or not. But the third landmine happens all the time. Under-withholding from your wages. Okay? Unfortunately, there's a common misconception that taxpayers think that whatever was withheld from their wages or their income is enough to pay the tax you owe. Well, they took the taxes out. Well, they took some taxes out. Your employer, or if you're taking retirement plan distributions, withholds based on what you tell them to withhold. And that's not necessarily your marginal tax rate. So you could have some other things going on that cause you to under-withhold. The most common things are going to be, one, you change employment and you just go in that first day and fill out the forms and you're off for withholding. Two, you have a change in marital status. Three, you have if you are married, that your spouse has a big change of income, or you have a change in dependence. So a lot of times people will change nothing. I'll give you an example. Let's say let's say you have a married couple and they are both making about $100,000 a year. One's making, let's say, 60. Rather, let's change it up. One's making 60, one's making 140. The one making the 160, let's say they get divorced, and the one making the 60,000 doesn't have a dependent. Now they're filing a single, but they're not getting a ton of withholding out of their W-2 wage, and they could owe and they didn't even know it. So make sure that you're running some numbers and you have the adequate amount of withholding, because that'll sting you. And there's times, another example of when people get stung is when they're getting a big bonus and they want to tell them, well, I'm getting my bonus for the year, I don't want to have to go with taxes. Well, the misconception is the amount that's going to your tax is based on your marginal tax rate, not your withholding. So they tell their employer not to withhold much tax, but then they owe it at the end of the year and they forget. So withholding does not equal the tax that you actually pay. It's just the amount that's taken out of your wages or retirement income in anticipation of what you're going to owe. So under withholding is my number 3 tax landmine. And if you have a major change to your tax situation, talk to a tax professional. It's worth it to talk to someone to make sure that you're on the right track.
Which I can see that one happening a lot too. Somebody is switching employers, so they got to prove something like that where their, paperwork is reinitiated. It's almost just out of antsiness, excitement that like, yep, just checking boxes, filling out, and then, oh crap.
It happens a ton when you have a married couple. Let's say you have one person that let's say they're making $100,000 a year. The spouse, let's say they have children, the children are in school, so that spouse goes back to work part-time. Let's say they go work for the holidays at a retail shop, or they a teacher's aide or something part-time. And they make $15,000 to $20,000 that year. But because then there's not much withholding on that 15 or 20 grand. So when you combine their incomes, then they owe $4,000 or $5,000 at the end of the year, and they're like, what happened? So now that's where you've got to be careful. And I have one more bonus as we put a wrap on this. One more bonus. Came to me right when we started. It's somewhat related to withholding. The 10% penalty for early retirement distribution can be a dagger to people. So understand if you're, let's say, age 40 and you pull money out of your 401k and you don't meet one of the exceptions, what might happen is a 401k company might withhold 20%. You might say, oh, taxes are withheld out of this. However, you're going to pay tax at your marginal tax rate for that distribution and a 10% early distribution penalty on the federal return. So that 10% early distribution penalty applies to many, many people. There are ways you can hopefully plan around it, but once you pull that trigger and take the money out early, it really eats into your tax. I'll give you one more too. Actually, why not? We're on a roll here. The other one related to retirement plan distributions. Let's say you have a 401k plan and you take a loan against it and you're paying that loan back. So the loan's tax-free. You're paying that loan back through your W-2 wages, so through your payroll. And either your employment status changes, so let's say you leave your job, or let's say the employer gets bought out and they call the amount you owe on the 401k. That's kind of phantom income. You don't have the cash anymore. You have no way to pay it back. That's taxable with a 10% penalty.
Ooh, that's a wild one right there. But yeah.
It happens all the time. So point is, talk to your tax professional or jump in to our Defeating Taxes private Facebook group and ask some questions. There are people there to help you. And I really, it's one thing when someone says, look, I'm going to sell this rental property. I know I'm going to owe X amount of tax, but I've got to free up some cash for something else. As a tax planner, you can understand those things and it just it really eats at you when someone makes a decision that has a landmine or unintended consequence. And there's nothing you could do about it.
Makes sense. And that's ignorance is not bliss when it comes to taxes, right? Ignorance is very, very expensive for a long time, right? It's not like there's not a lot of white flags and apologies and asking for forgiveness when it comes to taxes. So Chris, to your point too, we talked about tax planning now, I think 3 or 4 times, if not more than that, just on this specific show, or this episode. So if you don't see a trend here, you probably got bigger problems. that tax planning is so important. It is something that, I wouldn't say is relatively new, but I think it's gaining, as we mentioned, a lot more popularity because people are seeing, the positive, very, very positive outcomes that it's producing for literally. And, I say this personally, I think that my opinion, and Chris, tell me if I'm wrong, I think, and just getting over that first initial, okay, I'm interested in tax planning. Not even I'm going to do it, but I'm interested in it. What is it? It's not that hard. I mean, realistically, it's just having a conversation with your tax professional and just think about it, right? Like say you have a number in your mind for anybody that's listening to this, hey, this is how much I make per hour. This is how much, whatever I want to make per hour. You will save likely, I'm not going to put a number to it, but likely way more than that just by the little amount of time you're going to put into tax planning, that initial one, and then year over year it kind of gets easier and easier, although things change. But just the amount that you'll save and just a peace of mind, you won't, my little personal information, my birthday is actually quote unquote tax day. So anything I can do to avoid anything else going on my birthday is a beautiful thing. So I challenge everybody that just consider it. Don't even Google it. Don't do anything. Just think about what that means to you, tax planning. We'd love to hear it. Shoot us an email, hello@teachingtaxflow.com. Get into Defeating Taxes, as Chris had mentioned too. And on that note, I'm going to make a post probably today. So, August, it is August. Holy cow. August 27th, 2024. I'm putting it out there on defeatingtaxes.com. It'll take you directly to that private Facebook group of some questions you may have. Send us these questions. Again, if you can post anonymously to that group. If you're not a member, it's easy, free. Click on it, you're in. We are going to do an episode, not exactly sure which one it's going to be, but it's probably going to be within the next 4 weeks or so of rapid fire questions. So Chris says that he is not nervous about these. And I know he knows a lot of answers, but let's try to make him a little nervous. Let's ask some hard questions. And we are going to get through a ton of these. So don't think that if you send them to us, we are not going to have them answered. We are going to have them answered by Chris in one way, shape, or form. So please send those over. and we look forward to it. So I challenge you with that. Look at tax planning, consider it. Have any questions, reach out to us. That's what we're here for. And get on Defeating Taxes. Look for that post being posted today, August 27th. That's the day that this podcast goes live. And let's get down to business. The year is ticking away. Time's ticking away. Let's plan for an amazing, amazing next year and a future for years beyond. So thank you, everybody, again, for joining us here on the Teaching Taxable podcast. As always, we will see you back here. Same place-ish, different time-ish, different topic for sure.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.